So welcome everyone to yet another amazing session on CA Final Financial Reporting, and I hope my audio is absolutely amazing. So we are back here to revise financial instruments again, right? Again, in the sense you might have seen the first part of financial instruments revision, where I had revised till this point, till accounting of equity instruments. So if you haven't watched it, first watch that and then resume with this session. Okay. Also, if you are watching this on YouTube, don't forget to subscribe to the channel. Also, do hit a like button if you like it, and also do share it with your friends. The board notes which I'm going to refer here, I will upload on my Telegram, so you can download it from there. Okay. Just to remind you, in this revision lecture we are going to revise the concepts as well as the questions which are going to be relevant definitely from exam point of view. Okay, so without wasting any time, let's start. Let's continue the revision. Okay, so I'm starting the revision, continuing the revision in 3, 2, 1 and go. First of all, in the previous lecture we had revised till this part, accounting of equity instrument. We had revised till the basic measurement and everything. From this revision lecture I'm starting with 7th point, reclassification of financial asset and financial liability. Now what is the meaning of the point reclassification? First let's talk about financial assets. Acha, do you remember for financial asset we had which methods? We had ACM, we had FVT OCI R, we had FVT PL, we had FVT OCI NR. These methods were there. Acha, which method do we choose? Is it the choice of the company? The answer is no. It depends on the outcome of two tests, business model test and CCFC test. So now, if your business model previously suggested ACM, but now the company has changed the business model, so can we change the method as well for the financial assets? The answer is yes. That is known as reclassification. So basically reclassification means change in the accounting method. So basically previously you were following ACM, now you might have to follow FVT OCI R, or previously you were following ACM, now you have to follow FVT PL. Okay, so do remember this reclassification happens only when there is a change in the business model, and if this change is to be done, it is to be done at the beginning of the year. Okay, out of these 4 cases you can reclassify between any cases, but in one method reclassification not permitted, and that is FVT OCI NR. Because in case you remember, we choose FVT OCI NR only when there is only when we wanted to choose an irrevocable option. Whenever you choose FVT OCI NR, FVT OCI NR in itself is an irrevocable option. That is why if you choose this method, you cannot change the method anytime. Okay, then the basic stuff is given. If you are going from the old method to new method, then how will the accounting be done? Just give it a read. Okay, from exam point of view, you should just know that this is possible and just give it a read. Okay, that is fine. In the revision lecture, of course, my focus is mainly on those parts which are more relevant from exam point of view. Anyways, what about financial liability? Reclassification in case of financial liability is not permitted. Why? Arey baba, in case of financial liability already we have only one method, ACM. In few cases we might use FVTPL, but in most of the cases we have only ACM, right? So if you are running alone in the race, then how can we reclassify, right? Oh yeah, oh yes sir. Chalo. So this was reclassification. Now the next point is going to be derecognition. Okay, derecognition of financial asset. Now let's start discussion about the same here. Now first of all, let's understand what is the meaning of derecognition. Derecognition simply means removing anything out of your books. That is known as derecognition. So when will a financial asset be removed out of your books? So there are 2 types of derecognition discussed here. One is full derecognition and one is partial derecognition. Okay, in full derecognition, it is very simple. So let's suppose, for example, I have a financial asset in the name of investment in debentures. Tell me, when will I remove this investment in debenture out of my books? In 2 circumstances. First, when the life is over. What is the meaning of life is over? For example, you were supposed to receive interest, you have received all the interest payments. You were supposed to receive principal, you have received all the principal repayments. So when you have received whatever was promised to you, life is over. When the life is over, financial asset will be nullified from my books. Okay. Second instance can be sale. When you sell this financial asset, at that time also you can derecognize the financial asset. So these are the 2 instances where you will derecognize the financial asset. Okay, then this was a full derecognition. That means full derecognition can happen only when your contractual cash flows are fully received from financial asset, or you have transferred or sold the financial asset. Simple. And whenever you derecognize the financial asset, if you are selling it, whatever profit loss is there, it is a realized profit loss, transfer it to P and L. Is this clear to everyone? Good job. Then we discuss about partial derecognition. Okay, in partial derecognition there are multiple cases, but as I already told you while I was teaching, focus on that one question of C limited. Don't worry, I will revise you everything once at least. Okay, now what is the meaning of partial derecognition? So basically under partial derecognition there are three definitions given. How many definitions? Three definitions. If you fall under the three definition, then you will call it a partial derecognition. So first let's discuss the three definitions and then I will teach you the accounting as well. Okay, now what was the first definition point talking about? First of all, let's try to understand in any financial asset. Let's for example say in case of we have investment in debentures. So is it a financial asset? Yes. How many cash flows are there in debentures? 2. Interest and principal. Okay. Now what the three definition says is, first of all, please remember it is a partial derecognition. Acha. The first definition says is the part transferred comprises of specifically identified cash flows. Now in case of investment in debentures there are two specific cash flows. Let's say out of the two cash flows I have transferred any one cash flow. Remember sale of, we sold only the interest portion of the financial asset, or else we sold only the principal portion of the financial asset, right? So that can be known as the partial derecognition. I also explained to you with the help of a chart how this whole thing happens. Okay, not going into the depth as of now because it is a revision lecture. Anyways, so the first definition is when you transfer any one out of the two specific cash flows. Okay. Second, part transferred comprises of fully proportionate share of the cash flows. That means you are transferring both the cash flows but not 100%. You are transferring some proportion of both the cash flows. Let's say for example you transferred 40% of both interest and principal, or you transfer 30% of interest and 35% of principal. So that time you will fall under definition point number 2. Or else third part transferred comprises of fully proportionate share of specifically identified cash flows. This means you are transferring any one cash flow out of the two, and also in that one cash flow you are not transferring it fully, you are transferring some proportion of it, right? For example, you are selling 40% of interest portion, or else you are selling 30% of principal portion. Okay, so if you are falling under any of the three definition, then you will fall under partial derecognition, case number A. So in partial also there are three cases, case A, case B, case C. So if you fall under three definitions, you are falling under case number A. So how is the accounting done in case number A? First let's discuss and then we will also revise with the help of one question. So in case number A, what we will say? First of all, because you are derecognizing only a part of the financial asset, you will derecognize that part at carrying amount. Okay, and because you're selling something, you will receive some money. Okay, so whatever is the difference between the selling price and the carrying amount of the part derecognized will be transferred to profit and loss. So because we are not selling the full asset, there will be some part retained. If there is some portion which is retained, that retained portion will continue to appear in the balance sheet at carrying amount. I will prove this with the help of an example, so don't worry about it. Acha. Now one more thing. While I was giving you some examples of the three definitions, I also told you if the three definitions have these words. Let's say for example I was saying sale of 40% interest, or sale of 100% interest, or sale of 30% principal, then we were falling under partial derecognition. Okay, but when I say sale of first 2 years of interest, sale of last 2 years of interest, sale of first 20%, sale of last 40%, whenever you see the words first and last, always remember we will not fall under the three definitions. Remember I gave you the logic in the class also. Okay, so whenever you see the words first and last, you will not fall under the three definitions. In that case, accounting of partial derecognition does not apply. In that case, we will do the accounting of full derecognition. So what is the meaning of full derecognition? That means even if you are selling a part of the asset, still you will derecognize the full financial asset. You will derecognize the full financial asset. At what value? At carrying amount. Then whatever part you have retained, you will re-record that at fair value. See, for example, I have sold only 70% of the asset, but still I will remove 100% of the financial asset. Okay, then I will re-record the part retained, but the difference here will be the retained part is re-recorded here at fair value. Okay, of course you will also record the proceeds which you received from selling the financial asset, and the difference whatever is there, it will be transferred to profit and loss. Don't worry, I will justify this with the help of an example as well. Okay, so what is the difference between case 1 and case 2? The only difference is in case 1 we apply the accounting of partial derecognition, and here the retained part continues to appear at carrying amount only. In case B, when there is words first and last, we apply the accounting of full derecognition, and here the retained part is re-recorded again at fair value instead of carrying amount. Okay, so what is case C here? Remember, case C is nothing but whenever there is service fees also involved. So there is case A along with service fees or case B along with service fees. In that case, you will fall under case C. Anyways, now we had one question for this discussion, and that was the question of C limited. Remember the discussion of this question. Whenever you are revising derecognition, do revise this question as well. Okay, so I'll just give an overview revision of the same. What was there? We had a financial asset worth 10 lakhs. Okay, EIR was given 18%. Today's fair value is this much. Okay, now we are selling portion of the financial asset, right? So it is given other way around. We sold the principal and interest, everything we sold after retaining 10% principal and 4% interest. Okay, so can you see any word like first 10%, last 10%? The answer is no. So can I say it is falling under case number A, where you are selling some portion of both the cash flows, selling some portion of principal, selling some portion of interest, right? Okay, sir, got it. So it is a case of partial derecognition, case A. What is to be done, sir? Simple. Whatever part you are selling, you will remove that part at carrying amount. And you will record the proceeds received. Difference will be transferred to profit and loss. And the retained part will continue to appear at carrying amount only. Okay. Also, there is a 2% service fees involved here. That is 65,160. So it is mentioned that the interest component includes whatever the amount of interest is given. It already includes the service fees. Okay. What is the concept of service fees, sir? Basically, when you sell the part to some third party, the money will initially be received by the main party and then it will be transferred to third party. So he will charge a service fees like a commission basically. Okay. So now how is the accounting to be done? See, it is very simple. Have a look here. One second. Yeah. So let's say we have the carrying amount of the full asset, 10 lakhs. But the issue is we are not selling the full financial asset. We are only selling that particular part. Okay. We are only selling the particular part. So ideally, I need the bifurcation of carrying amount. What is the carrying amount of the part which is derecognized and what is the carrying amount of the part which is retained? I don't have this bifurcation. How do I bifurcate? I have the fair value of both the parts. So I will bifurcate in the ratio of fair value. So my next step is finding the fair value of the part retained and the part derecognized. The fair value of the part retained is given in the question. If you read the question, you will find the fair value of the part retained. So if total fair value is this much, and retained part fair value is this much, you can find the fair value of part derecognized by using the balancing figure. Okay, but why am I finding the fair value? The logic is simple. In the ratio of fair value, I will bifurcate the carrying amount. So you bifurcated, you got the carrying amount. Now what to do? This is the part which you have sold. So this will go out. So you will say to financial asset 825,468. Okay, now you have sold it for 9,90,000. So you will record the cash bank received. Difference will be transferred to profit and loss. And as mentioned by me, the retained part will continue to appear at carrying amount. So the retained part carrying amount was this much. So it will continue to appear this much only. Also, I gave the bifurcation of during this retained part, what is the amount of principal, interest and service fees. So that bifurcation you can get by bifurcating the ratio of fair value. Okay. So this was the normal question which you just did. But in class, do you remember I also gave another case? Assume in the above question, there was words first and last. If there was words first or words last, then it will not fall under the three definition. Then we will say that you will have to apply the accounting of full derecognition. The only difference between above example and this example will be that you will derecognize the full financial asset and you will re-record the retained part again at fair value. Difference will be any which ways transferred to profit and loss only. So this was the case created by me, not there in module. Okay, do remember that part. Anyways, done with this. Yes, perfect. So this was the derecognition of financial asset, the main portion. Okay, now there is one more concept which we have to discuss under derecognition, and that is some special cases I mentioned. Let's discuss them. First special case is bill discounting. What is the meaning of bill discounting? Let's say I have a bill where I'm going to receive a payment after 3 months. Okay, so I go to the bank and tell me that you keep this bill and give me some money. Okay, so bank takes the bill and discounts them. For example, the bill is worth 10 lakhs, but bank will only give you 9 lakhs. Why? Because bank is charging 1 lakh rupees interest or commission, whatever you can say. Now, ideally what we used to do when we were discounting the bill, we used to remove the bill from our books. But what India says, when you are discounting any bill from bank, the risk and reward are not yet transferred to the bank. Why? Because if bank after 3 months is not able to recover the money from the party of bills receivable, it will recover the money from you. It will recover the money from you. right? So that means the risk and reward have not been transferred yet. Okay, so in that case, what India says is you should not de-recognize the financial asset and record the proceeds. Instead, it is just like taking a loan against the mortgage of bills receivable. So you will record cash bank to financial liability. You will not de-recognize the financial asset on day one. Once the 3-month period is over, once bank receives the money from the party, that time you can reverse the loan and you can de-recognize the financial asset. Okay, this was one special case which I discussed with you, bill discounting. Similarly, we have 3 other cases. Factoring. Under factoring, we have 3 cases: factoring with full recourse, factoring without recourse, or factoring with partial recourse. Now, what is the meaning of this? Factoring with full recourse simply means that what is the meaning of factoring first? Just like we sell bills receivable to bank and receive money on day one, similarly, we sell debtors to a third party and receive the money on day one, right? So let's say, for example, I have so many debtors, but they are going to repay me after 6 to 9 months. So I will sell my debtors to a third party, to a factor. He will give me the proceed on day one itself. Now, factoring agreements can be of 3 types. One is factoring with full recourse. What is the meaning of full recourse? When you sell the debtors to the factor, at that time, the full risk is retained by the company, full recourse. That means when you are selling the debtor, you are not selling the risk. What is the meaning of not selling the risk? If the factor is not able to recover the money from debtors, it will recover the money from the company. Simple, right? So risk is retained by the company in this case. So in this case, when the risk is retained by the company, you should not de-recognize the debtors on day one. Whatever proceeds you receive, you should record it as a financial liability. Simple, clear? Okay. Second case is factoring without recourse. Without recourse means you have sold the debtors to the factor. Now the company's risk is over. If factor is able to recover the money from debtors, very good. If this factor is not able to recover the money from debtors, is the loss of the factor himself. Company will not do anything in this case, right? That is known as factoring without recourse. So what is to be done in this case? In this case, whatever proceeds you receive, you will record it and you will remove the financial asset. Why? Because risk and reward have been transferred. Okay, done. And difference will go to profit and loss. Now, third and the important case, from exam point of view, this is important in de-recognition, and that is factoring with partial recourse. Factoring with partial recourse. What is partial recourse? Partial recourse means you have sold the debtors, but you have retained some partial risk. For example, in case you remember, we discussed one example for this as well. Let's say, for example, I have a debtors worth 5 lakhs. I sold it for 4,50,000, but I retained the risk up to 20,000. That means if the factor suffers a loss up to 20,000, I will reimburse him. But if a factor suffers a loss of more than 20,000, then it is a loss of the factor. Up to 20,000, we will reimburse the factor. That means we have retained the risk only up to 20,000. That is known as factoring with partial recourse. Now, how is the accounting to be done in this case? So I will take this example as a base. So let's say debtors were worth 5 lakhs and factor paid me 4,50,000 for that debtors. Risk I retained for 20,000 and the fair value of this risk is 5,000 respectively. And there are 3 cases given. Let's discuss the accounting on day one. First of all, in partial recourse, you will de-recognize the full financial asset. So whatever proceeds you received, you will record it. You will remove the financial asset, record the difference in profit and loss. But can I say you retained some risk? So for the retained risk part, you will record one asset and one liability, and that is continuing involvement in asset account debit to associate liability. Sir, why an asset and why a liability? Because you have retained the risk, so liability. But why asset, sir? Because the risk will arise only when debtors are not able to pay. That means the first liability is of the debtors to make the payment to factor. If debtors do not pay, then only I will have to pay. That means I have an asset also now. Why? Because primarily my asset is responsible to make the payment. Therefore, one asset, one liability. Okay, so I recorded it at 20,000, 20,000. Then whatever fair value is given, let's say the fair value is given of 5,000. So for that 5,000 fair value, you will record P&L to associate liability. What is the meaning of this 5,000? It simply means that if you have retained the risk of 20,000, on day one, what do you feel? How much payment you will have to make under this risk? So on day one, we feel that my loss is going to be 5,000. So I recorded at 5,000 P&L to associate liability. Now you will say, sir, your associate liability becomes 25,000, but you retained the risk of only 5,000. Na? Then how come you're recording 25,000? Just remember that ideally we are not recording 25,000. Ideally, against the initial 20,000, we recorded an asset also, right? Then we recorded extra 5,000. So effectively in net, we are recording a net liability of only 5,000. Okay, Just remember that part. Also, then I had given 3 cases. Case way, I had taken this example one step ahead, right? In module only day 1 accounting is discussed. Okay. Also in day 1 I say na P&L to associate liability. Remember I had given you a note in as per ICAI they are not recording the full difference on in profit and loss on day 1. They are saying that they want to book this over the period, so they transfer this as well to CIA, continuing involvement in asset accountability. That is as per ICAI, but ideally it should be profit and loss. Anyways, like in exam do as per ICAI only. Okay. Then there were 3 cases. These 3 cases are not there in module. I have discussed this case. What are the 3 cases? What if debtors pays only 4,90,000? Can I say in that case I will have to make the balance 10,000 payment because risk up to 20,000 I was ready to bear. So whatever asset liability is there, first reverse it. Whatever payment you have to make, because debtors only paid 4,90,000, now it is the company's duty to make the payment of 10,000. Right? So it will make the payment of 10,000 and record the balancing figure in profit and loss. Similarly, in case number B, if the debtors paid full amount, no liability will arise in my case. In case number C, debtors paid only 4,20,000. The loss of factor is 80,000, but I will only reverse him 20. I will only reimburse him 20,000. Do remember that part. Not going into detail for this entries because not relevant from exam point of view. After this, what you should do is, as soon as you read this provision of factoring, you have to discuss illustration. You have to revise illustration of 124A, B and C. Not LDR, but exactly similar to what we discussed in my example. So not wasting time in revising it again. Illustration 124A, B and C you can revise. It is a straightforward question. Okay. Acha, do remember when you are studying derecognition, many students face very much discomfort with this topic. Let me tell you, it only has 2 things. One is the question of C limited that I already told you. Bifurcate the carrying amount in the fair value ratio and derecognize. Simple. And second thing is factoring. That's it. Nothing else. So even if you are comfortable with these 2 parts, it is sufficient for me. Okay, do remember that part. So don't create any havoc, right? Oh my god, it is difficult, it is tricky. No, it is very easy. It is very easy. Oh yeah. Chalo, done. So this was derecognition. Now I guess we can proceed with the next point, and that is what we discussed above was derecognition of financial asset. Now what we are going to discuss is derecognition of financial liability. When do you derecognize a financial liability? When you have made the payment. For example, there is a creditor. When will I derecognize the creditor? When I made the payment to a creditor. So it is said that derecognize the financial liability from balance sheet when it is extinguished. That is when obligation specified in the contract is discharged or cancelled or expired. First thing. So in that case, you will remove the financial liability. Acha. In financial liability, there is also a concept where you will not remove the full financial liability, but there are some modifications in the original financial liability. So for modification, for these 3 pointers, we will refer directly to the next point. We will go on to the next point, and that is modification. Okay. So nothing major in this point as of now. Okay. Now let's discuss about modification. Now what is the meaning of modification? First, let's try to understand that part. Let's say, for example, this is AK Limited. This is Chetan Limited. I took a loan from Chetan. So for me, it is a financial liability. Now let's assume I made repayment for year 1, repayment for year 2, repayment for year 3. In 4th year, I got committed. When you get committed with a girlfriend or boyfriend, in that case, you don't have funds. You only have funds to give gifts to girlfriend, boyfriend. Now I don't have funds to make the repayment. So when I don't make the repayment, and I request my dear Chetan that I'm really very sorry, I won't be able to make the repayment for this year. So please change the repayment schedule for me. So either Chetan will help me by reducing the interest rate, or he will help me by changing the tenure. That means your original terms are not holding true now because I have made a default. I have made a repayment default, right? So in that case, we will apply modification accounting. What to apply? Modification accounting. So modification accounting is discussed from both the cases. From the case of borrower, for whom it is a financial liability, and from the case of lender also, for whom it is a financial asset. So first we will discuss about modification accounting from the case of borrower, for whom it is a financial liability. Now how does the borrower account for this? So first of all, in modification accounting also I have given you specific steps. Okay, what is going to be my step number 1? First you will identify whether this modification is substantial or not. For example, let's say, do you remember what is the meaning of this? Let's say, for example, Kishan is there. So Kishan cheated with his girlfriend. So you will have to identify the quantum of cheating, how serious it is. So if it is a small cheating, Kishan just kissed a random boy, So girlfriend is fine, okay. If you're kissing a boy, it's okay. Okay. So that in that case, we will say the crime by Kishan is not very substantial. But if Kishan committed a bigger crime, can I say it can lead to breakup? Similarly, in case of loan, you will have to check how is the modification, whether it is substantial or it is a small minor modification. Okay. How do we check it, sir? For this, you have to compute two amounts. First, carrying amount of old financial liability on date of modification less present value of revised future cash flows, including transaction cost outflow at old DIR, divided by the carrying amount again. So, whenever you are doing the modification, you want the carrying amount as on that date. Compare that with the revised future cash flows present value at old DIR. When you compute revised future cash flows, also don't forget to add a transaction cost, okay, and discount them at old DIR and divide again by the carrying amount. Don't worry, I will discuss this all things with the question also. Acha. Then you will get, when you solve this, you will get something in percentage. Whatever sign you get, ignore it. Now, if this percentage, the answer you get, the base is 10%, okay. If you get the answer at less than 10%, we will say modification is not substantial. But if we get the answer as more than or equal to 10%, we will say modification is substantial. Accounting in both these cases is little different. If the modification not substantial, tell me one thing, not substantial na? So should I do breakup? No. So in this case also, if the modification not substantial, I'll give you two options. Chalo. Not substantial na? So two options you have. Either you can do small adjustments in the old loan itself, or you can say, sir, modification has happened, so I will remove the old financial liability and record the new financial liability. Tell me. Two options. Either make small adjustment in the old financial liability. Second option, remove the old financial liability and record the new financial liability. So, of course, when the modification not substantial, can I say it is better to adjust in the old financial liability itself because it is a minor modification, na? Okay. So here also it says the same thing. When the modification is not substantial, whatever adjustment you are doing, do it in the old loan itself. How do you do the adjustment? Simple. Whatever transaction cost you incurred in the modification, adjust it from the old financial liability. Now, because your old financial liabilities carrying amount will change, you will have to compute a new EIR in this case. How to compute a new EIR? And why to compute a new EIR? How to compute it? Apply interpolation. Why to compute it? Because of two reasons. Because of transaction cost to adjust from carrying amount. So the carrying amount changes, LAT won't match. Second thing, even your repayment schedule has changed. So you will require a new EIR. Okay. So if the modification not substantial, further steps are going to be adjust the TC from old financial liability, compute a new EIR, and then prepare the LAT after modification. Do remember, when you are preparing the LAT, under opening, take the carrying amount of old financial liability after deducting the transaction cost on modification. In EIR, take the new EIR which you just computed, then repayment, then closing, your LAT will tally. Okay. Acha, what if the modification turns out to be substantial? In that case, if there is a major loss, it leads to breakup. Breakup means you will de-recognize the old financial liability at carrying amount. You will record the new financial liability. How to find the values, I will teach you, don't worry. Difference will be transferred to profit and loss. Whatever transaction cost is there, it is directly transferred to profit and loss. And then prepare the LAT after modification. Now I just gave you an overview of the steps. Of course, just by reading the steps, you don't understand anything. So how about discussing some example? Okay. So in our textbook, we have certain examples in the form of solved examples, if you know, right? So let's say we come on towards example number 2. Okay. So see what was given here. Now I will teach you how to do the accounting for modification. Okay. Please be patient and listen to me very carefully. On 1st Jan 10, XYZ issues 10-year bonds for 10 lakhs. Interest coupon is 10%. Okay. And redeemable after 10 years. Okay. At 10 lakhs only. So there is no interest, no discount. No premium, no discount. And also there are no transaction cost on day one. So, acha, do remember, when you only have coupon, but you have no premium, no discount, and no transaction cost, in that case your coupon and EIR turns out to be the same. Okay. Anyways, on 1st January 15, that is after 5 years, there was a modification which was happening. How was the modification happening? It says that no further interest payments are required. Bonds are redeemed on original date only, but for 16 lakhs. Previously you were going to redeem at par. Now you will redeem at premium. Okay. And there is transaction cost of 50,000. Now how to account for this modification? Do remember, in modification questions, don't directly jump on towards the modification. every modification question, remember I told you bifurcate into two parts. The first part is going to be the accounting which was happening before modification, and then the accounting of modification will be done. Let's say for example, this was the loan, 10 years loan, right? So can I say modification happened after 5 years? So first prepare the LAT till 5 years. Okay, so how do we do it? First do the normal accounting. What are the normal steps? Step number 1, cash flows. Step number 2, fair value. Step number 3, EIR. Step number 4, LAT. In this question, there is no CFI, no relation, no level 1 input. So you can assume the fair value. Okay, so directly assume the fair value to be same as face value or transaction price, you can say. EIR, LAT is there. You will prepare the LAT only up to 5 years. Why? Because this is the date when the modification is happening. Prepare the LAT, stop here. So that is in modification types of question. First do the normal accounting. Done, sir. Then we will jump on towards the modification accounting. How to do the modification accounting, sir? First step number was, first check whether modification is substantial or not. How do we check it, sir? We need two values majorly. Carrying amount of old financial liability on date of modification. How do we get this? We get this from the LAT which we prepared till modification date, 10 lakhs. Second, what we need? Present value of revised future cash outflows, including transaction cost outflow at old DIR. What is the meaning of this? See, when you read this, the terms after modification, these are the revised future cash flows. So as per the revised future cash flows, no interest payment required. Principal will be done at the end of 19 only, but at 16 lakhs. Also there is some transaction cost on modification, right? So how do we do it now? So these revised cash flows, you have to find the present value. How do I find it? Just imagine we are standing on the date of modification and just recall what all things you have to pay during this 5 years. Why 5 years? Because the pending duration is 5 years. During this 5 years, no coupon is to be paid. Only principal payment is to be made after the end of 5th year. And on day 1, you are also incurring transaction cost. So these are all outflows. So just add all the outflows. Because TC is incurred on day 1, don't apply any discounting factor or apply the factor of 1. Because incurred on day 1, and this you are incurring after 5 years from the date of modification, right? So apply the discounting factor of 5th year at the rate 10%. So you will get this present value. Okay. Acha, now one doubt might arise, why we are adding transaction cost? In case of FL, normally we deduct it, na? Why we are adding in this case? Do remember here our motive is not to find the fair value. I have given the logics here. Okay, we can read them, but just revising you that our motive is not to find the fair value. Our motive is to find the present value of future cash outflows. When we are computing this, principal is also an outflow for us. This is also an outflow for us. So add both of them. Okay. Logics I have given here. So just remember, in case of transaction cost of financial liability, modification, under modification, this is the only case where we are adding transaction cost. In all other cases of FL, we will only reduce it. Okay, if you want to remember, you can remember it this way. Anyways, so you get the value at this much. When you compute the percentage, you get us 4.35%. Can I say it is less than 10%? So modification not substantial. If it is not substantial, what should I do? Should I remove the old and record the new, or should I make the adjustments in the old only? So I will make the adjustments in the old financial liability only. How to make the adjustments? First, whatever transaction cost is there, you will adjust in the old financial liability. So I adjusted it. As soon as you adjust this, your carrying amount gets revised. Okay. Then you have to find the new EIR. Why new EIR is required? The reason being, because you have adjusted that transaction cost from carrying amount, and also a repayment schedule has changed. So new EIR will be required. Followed interpolation, found out the new EIR. Then prepare the LAT after modification. Before modification, prepared for the first 5 years. After modification, you will prepare for the remaining 5 years. Okay. In opening, take the revised carrying amount. Interest, take the new EIR. Repayment and closing, you will take as per the revised terms. It will match. Clear with this? This was example number 2. We also have one more example, example number 1, which was very similar to example number 2. The only difference is here the term is extended. In previous question, the term was not extended. Here the term is also extended. Okay, interest payments are not waived off. They are reduced to 5%. Okay, the bonds are redeemable at 15 lakhs and there is a TC of 1 lakh. TC means transaction cost. Okay, so the initial part of the question is same. Only the modified part is different. How do we do this? Again, same thing will happen. We will do first the normal accounting till the date of modification. It remains the same. Then we will do the modification accounting. Okay, in this first step is to check whether it is substantial or not. The procedure remains the same. Okay, now you can find it on your own. When you check this, you get the answer as 11.32%. Now, can I say it is exceeding 10%? So the modification is substantial. when the modification is substantial, what to do now? So it is a big fight. It leads to breakup. That means you will have to remove the old financial liability and recognize the new financial liability. Now, how, at what value do we remove the old financial liability? It get removed at carrying amount. Do remember, whenever any asset or liability goes out of your books, it goes out at carrying amount. Okay. Second thing, we will have to record the new financial liability. The new financial liability you will record at fair value. Okay, you will record at fair value. So what is the fair value? Please don't confuse this amount with fair value. This is not the fair value, Baba. This amount we computed only to check whether the modification is substantial or not. So what is fair value? Fair value is nothing but present value of revised future cash flows at new EIR. When we were finding whether the modification is substantial or not, we were using the old EIR. To find the fair value, we use the new EIR. Okay, and also the transaction cost treatment is different in this case. So how do we find? We already have the future cash flows, revised future cash flows, discount them at the new EIR. Sir, how do we get the new EIR? It is given in the question at 11%. If you see, it is given that new EIR is 11%. Okay, so we discount them at 11%. We get this value, difference transfer to profit and loss. Sir, what about the 1 lakh transaction cost which was there in this question? You will have to adjust and transfer it to profit and loss directly. The only case where TC is getting transferred to profit and loss. Sir, why profit and loss? Just one assumption you can take is that this TC was incurred for the old financial liability. So when the old financial liability is out of your books, you should also remove the transaction cost out of your books. Simple. This is one of the assumptions which you can take. There are multiple reasons for this, but giving you the simpler one. Okay, then you will prepare step number 4, LAT. So what are the steps? Summarization. Step number 1, check substantial or not. If it is substantial, remove the old FL, record the new FL. Then transaction cost will be transferred to profit and loss, and the last step is LAT after modification. Okay, please remember, my motive here is to just recall you the steps and just revise everything for you. My question revision is not a replacement of a writing practice. Of course, you will not gain confidence just by referring to my lecture and referring to this question when I'm revising it. Of course, you will recall things, but if you want to gain the optimum level of confidence, you should also focus on self-writing practice. That is the key. That is going to be the key. Please do remember that part. Okay. Anyways, chalo. Now, for borrower, we solved 2 examples. There was one big question also in case of modification. Let's check that question out as well. Okay. That is illustration number 124. Okay, one sec. Yes, now we will revise this illustration 124. It is also a question of modification from the point of view of borrower. Okay, let's quickly revise this question. What was there? Do remember, in class also I mentioned, do write and practice this question. It is very important. Okay, chalo, let's continue. Wheel Company Limited. One second. So it was given this Wheel Company Limited borrowed 50 CR from a bank. So we are a borrower. Original terms are given. Interest coupon is given. Repayment of principal in 5 equal installments. My God. Do remember, I already told you, whenever principal repayment happen in installments, for step number 1 cash flows, you will also have to prepare a working note number 1 cash flow table. Okay. Then payment of interest annually, upfront fees. This is the transaction cost, but not on modification. This is the TC on day 1. This much. See, just remember, when your coupon is there, you don't have discount, you don't have premium, but you have TC. So your EIR and coupon won't match. It will be different because in EIR you want to amortize the TC also. Anyways, so it is given directly. So 11% is your coupon, 11.5 is your EIR. Acha, if this was not there, then coupon and EIR would have been the same. Anyways, okay, sir. Then after 2 years, there was some modification which was happening. Let's talk about the modification later on. First, how to do it. As I said, divide the question to 2 parts. One is before modification, one is after modification, right? How do we do the before modification part? So first step is going to be cash flows. Because even principal is getting repaid, you will have to prepare a cash flow table. So I prepared the cash flow table. I repaid the principal in 5 equal installments, and for interest, I took whatever accrued was there. Okay. Do remember, when you're preparing cash flow table, columns are same as LAT, but in opening you write face value, in interest you write coupon. Okay, we got this, sir. Then step number 2 is fair value of FL. I gave you a shortcut. In this question, there is no relation, no CFI, no level 1 input. So you can directly assume the fair value to be TP less TC. Okay, I assumed it. I got the fair value answer. Then step number 3 is EIR. It is given. Step number 4 is LAT. Okay, LAT you will prepare only up to the date of modification. Barabar. So in this case, You will prepare up to the date of modification. That means you will prepare only for the first 2 years. Okay. Now, for the first year, we prepared the LAT, done. For the second year, do remember that this was the date. This was the date when the modification was happening, right? So if you are doing the modification on this date, definitely you might not have the money to make the repayment of this date, right? So that is what is assumed, that you don't have the money to repay what is the installment on the date of modification. But in question, one thing is mentioned. Before approaching the bank, wheel company made the interest payment on 31st December 12. Do remember, every year we are paying two payments. One is principal, one is interest. So it is said that when you are approaching the bank for modification, you don't have the money to make the principal repayment, but you only have the money to make the interest repayment. So you only made the interest repayment in the question. Okay. Now, if you are making the interest repayment, then this is the closing balance of your loan. Also, I made you write one thing, that what is the outstanding principal's face value. For example, your loan amount was 50 lakhs. You paid the first principal, you paid the first interest. In the second year, you only paid the interest. What is your outstanding principal amount's face value at the end of year 2? It is 40 CR. So this is the fair value of the loan outstanding, and this is nothing but the face value of the loan outstanding. Why am I writing this? It will be useful for you. Is this clear to everyone? Yes. Now we will do the modification accounting. Okay, so this was the before modification accounting. Okay, now under modification, just remember the steps. What was step number 1? So step number 1 was to check whether it is substantial or not. So check it. First we need carrying amount of old financial liability. We already have it through LAT. Then we need present value of revised future cash flows, including transaction cost at old DIR. How do we find this, sir? Read the question now. As per the revised terms, interest rate will be 15%. Repayment of outstanding principal will happen in 10 equal installments. My God, even in the repayment of principal on modification, it is happening in installments, right? That is why I've told you to found the outstanding principal amount, because when you are making the repayment of principal in installments in modification, you will only consider the outstanding principal. Na? What principal you have paid, you will not make the payment again. Na? Okay, then payment of interest on annual basis. Now, so in this case, you will have to, again, for this present value of revised future cash flows, you will have to prepare the cash flow table again for the revised future cash flows, right? So I prepared a cash flow again. Whatever opening was there, interest I took, then I found the repayment each year. Okay, and there is no TC, by the way, on modification. Okay, so whatever cash flows you get, you will discount them at the old year. You will get this value, 4512 22,791. Sorry, 4515 22,791. So you can now check whether it is substantial or not. You already had this. You will write the revised future cash flows, divide by this amount, you will get some answer. Okay, do remember, before proceeding further, what are the two most important points in this question? The two most important points are only that preparing the cash flow table in before modification part as well, and during the modification part as well. This question seems to be lengthy only because of this part. Only because of this part. Otherwise it is simple. Okay, so we got the modification as substantial. No worries, sir. Now, if it is substantial, what to do? Remove the old, record the new. So we will remove the old financial liability, record a new financial liability. Now, how to record the new financial liability? See, under the modified terms, there was no premium, there was no discount, there was no transaction cost. So there is a hint that your coupon and EIR is same. Your revised coupon and the EIR is going to be same, because no premium, no discount, no TC. And when the coupon and EIR are same, you know, I'll give you one shortcut. When these two are same, when coupon and EIR is same, your face value and fair value will be same. If you want, you can compute. You can discount the revised cash flow at new EIR, but it will come at 40 CR only. Why? Because when coupon EIR is same, face value, fair value is same. These are the small shortcuts which I have given you so that you save some time in exam. Do remember that part. Okay. So we removed the old, we recorded the new. Then whatever transaction cost is there, it will be transferred to profit and loss. In this case it was nil, and then just prepare the LAT after modification. It was only asked to prepare for another 1 year, so we prepared it. Okay, that's it. Now entries were also asked. How to pass the entries? Passing entries is a piece of cake. Why? Just refer LAT and pass the general entries. You have prepared LAT, just refer it, pass entries. For example, this was the old LAT. Record the opening first, then record interest, then make the repayment. Next year record interest, make the repayment. Okay, then modification happened, pass the modification entry. Then after that, record the interest, make the repayment. So just refer LAT and pass the entries. Okay, so this is what was asked question, which can consume a lot of time in exam if you have not practiced at home. So do practice that part at home as well. So this was done. Okay, this was illustration number 124, and with this we are done with the modification from the point of view of borrower. Now we will do the modification from the point of view of lender. From the point of view of lender, well, who is lender? Lender means the person who is investing or giving the money. For him it is a financial asset. So for lender, the accounting is not that complicated, like first checking substantial or not and then doing the accounting. No, for lender a straightforward accounting is given. What is the accounting, sir? Do remember, in case of financial asset, your EIR does not change. Okay, so what are the steps? First step is have to find the carrying amount of old financial asset. Second step is compute the present value of revised future cash flows at old EIR. Okay, compute the present value of revised future cash flow at old EIR. Revised cash flows information will be given. Okay, compute that. Then step 3, pass the journal entry for modification. How to pass it I will teach you while doing the question. And then step 4, prepare the LAT. So how to remember the steps? The step 1 and 2, can I say the step 1 and 2 resembles the step 1 of borrower? In case of borrower, remember we used to find carrying amount of old financial liability and present value of revised FCF at old EIR for borrower. Same is the case with lender. So borrower's step number 1 becomes lender's step number 1 and 2. Here we find in step 1 carrying amount of old financial asset. In step 2 we find the present value of revised FCF at old EIR only. Okay, then pass entry and then prepare the LAT. Okay, this is the basic steps for modification in case of lender. Now how to do it, sir? For this we will refer 2-3 questions we have. We will refer all of them. One is illustration number 123. If you read 123 on the face of it, it seems to be a big question of more than a page, right? But it is a very good question. Always remember, there are 2 ways of referring to a question. If you see it is very big and get scared, the second way of seeing it is that whenever a question is big, a lot of information will be given in the question itself, so your time will be saved. Okay, now how to solve it? So first of all, here we are giving a loan to employees. Okay, so we are a lender, we gave our loan to the employees. Oh my god, we gave the loan to the employees. That means relation is there. Oh yeah, relation of employer is also there. Okay, so we gave the loan of 10 lakhs. Interest was like on full 10 lakhs. A flat rate was not there. On the first 4 lakhs we will charge 4%. On the next 6 lakhs we will charge 7%. Starting date is this much, tenure is 5 years. Okay, principal will be paid in 5 equal installments. My god, again the principal is to be paid in installments. In step number 1 you will have to prepare a working note number 1. Okay, and whenever you pay the principal back, which principal will get repaid first? The 4% principal or the 7% principal? So whenever you are repaying, it clarifies that you will repay this first. This 6 lakhs will be first repaid. The higher rate of interest will be first repaid, and then you will repay from this. Anyways, chalo. Then interest accrues on annual basis. X remains in service to the loaner. Okay. Comparable loan 12%, that is the EIR. Why is the EIR and coupon different? Because relationship is there. Because you are giving a loan to employee, you are charging him less coupon, but market rate is may be different. Okay. Do you remember, whenever there is a relationship, you will find the fair value, and whatever difference come, where will it be transferred? Perfect answer, it will be transferred to prepaid employee benefit expense. Very good. Okay. Now some table is given. What is this table? You know what is this? What did I say? Because you are repaying in installments, you have to prepare a working note number 1. Luckily, that working note is given in the question. In step number 1, prepare a cash flow table. That is already given. I said now, when the question is big, given information is more. So how much of the cash flow each year, it is given in the question. Okay. Then some modification happens. How does the modification happen? At the end of second year, we had to repay 2 lakhs plus the interest, but the employee prepays extra 2 lakhs. So instead of making 2 lakhs principal repayment, he makes 4 lakhs principal repayment. So he prepays 2 extra lakhs. Okay, reducing the outstanding principal as on that date to okay. Then the revised cash flow are also given. Because you are repaying it early, what are the revised cash flows? See, as per the revised terms, you repaid extra 2 lakhs year itself. So only this much is pending after modification. Now how to solve it? Okay, let's try to discuss. First, again for this modification also, divide the question to 2 parts. One is before modification, one is after modification. First, what will happen before modification? Step number 1, find the cash flows. already given in the question. Step number 2, find the fair value. Okay, EIR is given. You will find the fair value. Compute. Why compute? Because there is a relation. Because you compute the fair value, there will be a difference between TP and fair value. Where will the difference get transferred? It will get transferred to prepaid employee benefit expense, and you will write off it over a period of 5 years. Why 5 years? Loan tenure was 5 years. Okay. Then EIR, then LAT. Prepare the LAT only for the first 2 years. Why? Because after 2 years modification was happening. So I prepaid whatever repayment was that I made. Acha, in this LAT till the date of modification, in the second year repayment, ideally I can also take 4,44,000 year instead of 2,44,000. Why? Because you are prepaying 2 lakhs extra, na? But that I will treat separately. Here I have only taken 2,44,000. This is done as per ICAI. Even if you take 4,44,000, it is fine, na? It is not a mistake. Okay, both will work, but still I will take only 2,44,000. The 2 lakh prepayment I will treat separately. Anyways, so this was the before modification accounting, simple. Then after modification, what do we do? Hello, mister, how do you do? What do we do? So after modification, what we do? Fine, follow the steps. Step number 1, carrying amount of old financial asset on date of modification. How do you get it? From the previous LAT. Second, present value of revised future cash flows. Revised future cash flows mean after you make the prepayment, refer the future cash flows. So after I make the prepayment, only 2 cash flows will be pending, these 2 cash flows. So I will find the present value of these. Okay. So just assume that the step number 1 is your old value. Step number 2 is your new value. Just assume this. Okay. So from old value, you have to come to the new value. So you have to reduce the financial asset by this much. Again, from old value, you have to come to the new value. So you have to reduce the financial asset. In the step number 3, you will pass a journal entry. How do you pass an entry? Because you have made a prepayment, you will say cash bank account debit. Okay. To financial asset. By how much amount? Whatever amount you wanted to reduce, you will record that amount in to financial asset. How will you adjust the difference? Normally the difference is adjusted in profit and loss, but because there is a relationship in the question, you will not adjust the difference from profit and loss. Instead, you will adjust the difference from the prepaid employee benefit expense. Why, sir? Because there was a relationship in the question. When there is a relationship, never ever adjust from profit and loss, always adjust from the prepaid employee benefit expense in case of employer-employee. Okay, so this is my step number 3. Because I made a prepayment, I passed the entry for prepayment also 2 lakhs. Then I adjusted the some amount with financial asset and then the balance with prepaid employee benefit expense. Acha, if there was no prepayment, then in that case you will just reduce the financial asset and you will adjust from prepaid employee benefit expense. Okay, I will refer that question as well. But because there was a prepayment, I took the prepayment effect in the modification part. Okay, as I was saying, I'm not taking the prepayment here. I passed a separate entry for this year. Okay, so what is going to be the impact of this entry? The impact will be that the financial asset will be reduced. From this value, it will come down to this value. First thing. Also, the balance of your prepaid employee benefit expense will reduce. How come? See, it was this much on day 1. Modification happening after 2 years. So you will first write off 2 years prepaid employee benefit expense. This was the balance before any entry, before any modification. Now, you adjusted some amount with the prepaid employee benefit expense. So how much amount will remain? Only this much amount will remain. Why? This was there. You reduced some value of it, so only this much is there. Now you will write off only this much prepaid employee benefit expense. That also over how many years? Ideally remaining tenure is 3 years, but you will write off this over only 2 years. Why only 2 years? Because we reduce the tenure now by making 1 year principal prepayment. Right? That is why. Okay, done, sir. So step number 4 is going to be LAT after modification. So just to summarize it again, how do we account for the modification? First, find the carrying amount of old financial asset. Second, find the present value of revised FCF. Okay, you will get both the values. Consider the upper one to be the old, the second one to be the new. You have to reduce this. Then pass the entry. You are making the prepayment, say cash bank account debit, to a loan amount, whatever you want to reduce, and balancing figure will be transferred to prepaid employee benefit expense. Because of this, the values of FA and prepaid both will change. Now prepare the LAT for FA, and for the prepaid also I have given the working. Whatever you did, just have to pass the entries. Passing entries is simple. Just look at the workings and keep on passing the entries. Okay, so this was a very good question. Of course, just try to revise it very quickly, but do solve this and revise. Okay, then we have one more question, and that is going to be question number 7. Again, it is a question of modification. Let's refer the question as well once. Come. Yeah, here it is. Question number 7. What does it have to say? It says we lent. That means it is a financial asset for us. We lent 2 CR. No relationship, nothing is there. TC is there 10 lakhs on day 1. Okay. So in case of financial asset, do you remember TP plus TC is the fair value? In case of liability, we less it. In case of asset, we add it. Already revised, huh? Okay. Then not to charge an interest. Coupon was 0 in this case. Okay. And the repayment will happen after 2 years. We were supposed to take how much? 2.4 share we will take. EIR is given as 6.9%. Acha, change the date, huh? Yeah, 20th Feb is that. Change it to 31st March. Okay. Now, after 1 year, there is a modification. And what is the modification? Previously, we were supposed to receive 2.4. Now, we will receive only 2.2. Okay. So, how to account for this modification? Simple. Again, divide the question into 2 parts. One part is going to be before modification accounting. So, you will say cash flows, fair value, because no relationship, no CFI, no level 1 input. You can assume the fair value. So, assume the fair value to be equal to TP, but there was TC also. So, add it. Okay. EIR is given, LAT you can prepare. LAT you prepared only for 1 year. Because after 1 year, there is some modification happening. Done till year. Then modification accounting you will do. How will you do the modification accounting? Follow the steps. First step, finding the carrying amount of old financial asset through the previous LAT. Second, present value of revised FCF at old EIR. The revised cash flow was reduced from 2.4 to 2.2. So take 2.2 cash flow and find the present value. You get this amount. Consider this to be the old amount and this one to be the new amount. That means you will come to know how much is the reduction going to be there. So reduction is of approximately 1869,019. Okay. Now pass entry in the third step. Here there is no prepayment unlike previous question. So you will not say any cash bank. In the previous question there was some prepayment which you are receiving. So we said cash bank. Here there is no prepayment. So directly pass the entry for reduction. So to reduce the financial asset, you will say to financial asset account debit, to financial account credit and debit what? Debit profit and loss. Sir, why profit and loss? Why not prepaid employee benefit expense? Here there is no relationship, na? So directly profit and loss. And why not cash bank? No prepayment is happening. So directly reduce the financial asset and debit to profit and loss. Prepare the LAT after modification with the new opening value. That's it. Done and dusted with this question. Simple question was there. There is one more question there. And that is question number 19. Okay, we can solve that question as well. One sec. Here. Okay, what is in question number 19? It is again a very similar question where employer is giving a loan to the employee. So that part of the question proves to be the same, where employer is giving loan to the employee. Okay, at what rate the loan is given? 0% is the coupon. What is the EIR going to be, sir? EIR is going to be 5%. Okay, so EIR 5% is given. Okay. Then it is said that on 31st March 13, there was some modification. Modification we will see later on. Okay. So coupon 0, interest free loan of 5 lakhs. Coupon, EIR is 5%. Okay. How to solve this? Acha, let's discuss the modification also. So originally the loan was only of how many years? It was only of 3 years, right? But we extended term by a further 3 years. That means now the loan will end on 31st March 17. Okay. And the repayment was supposed to happen at 5 lakhs. Now it will happen only at 2 lakh 50 because there is some financial difficulty faced by the employee. Anyways, explain the accounting treatment on initial recognition and after giving the effect of modification. Okay, let's see how to give the effect. See, simple. Again, simple accounting first before modification accounting. Step number 1, cash flow. Step number 2, fair value. You will compute it because there's a relation. Step number 3, difference transferred to prepaid employee benefit expense. Step number 4, EI. Step number 5, LAT. LAT prepare only up to date of modification. Done, sir. Then modification accounting. How to do it? Step number 1, carrying amount of old financial asset. We already get from the old LAT. Then present value of revised FCF at old EIR. You are standing somewhere here on 31st March 13. It is said that the repayment will now happen on 31st March 17. That also only 2 lakh 50. So if you count from year till year, take the 4th year discounting factor for this. So you got the present value, took this value. So this is the old value, this is the new value. You have to reduce the asset drastically because the repayment previously was 5 lakhs, now it is only 2 lakh 50. So of course it will reduce. So this reduces the financial asset. Okay. Now how to pass the entry? Because there is a relationship involved here. Normally such reduction will be adjusted from prepaid employee benefit expense, but as per ICI in the solution they have adjusted from profit and loss. No reason given for this, but in exam if you remember what ICI have done, do this profit and loss adjustment only. I also discussed this, ICI done something like this. Okay, anyways, so there was no prepayment happening here again, so no cash bank is involved. Directly reduce the financial asset and debit to prepaid employee benefit expense and then prepare the LAT after modification. do remember while passing the entry is not asked for the whole tenure. It is only asked for day 1 and the modification entry. So we passed it, done and dusted. Okay, so it is a very simple question again, only the part different being that we are adjusting the modification from profit and loss and not from prepaid employee benefit expense as per ICAI. Do remember that. Okay, done. Chalo. So this was the modification accounting in case of a lender as well. When you are through with this modification accounting now, so let me tell you one thing. We are done with this modification part. Okay, this is a very important part because if a question comes from here, it can come from approximately 10 to 14 marks. The weightage can be so huge, and on the face of it, if you see, there are only 2-3 big questions. Illustration 124, illustration 123, only 2 big questions. Others, if you are able to solve 123, 124, others are a piece of cake for you. So 2 questions worth 14 marks can come. Okay, now the remaining points are there, small points. We will quickly revise all of them. Okay, now we will do this point, regular way purchase sale, and then post we will do all the remaining points, right? So what is the meaning of regular way purchase sale? Let's come on towards the notebook. Very small points are remaining, nothing major to be worried, right? Here it is. Yes. Now what is the meaning of regular way purchase sale? Just remember that whenever you purchase any shares from stock market, the delivery of shares in your demat account does not happen on the day you place the order. It takes T1 or T2 for settlement time, right? T1 means the day you place the trade plus 1 more day it will take to get created into a demat account, or T2 means the day you place the trade plus another 2 days it will take to create into a demat account. So now let's say for example you place the order on 1st April and it got settled on 3rd April. So this 1st April is known as the trade date. This 3rd April is known as the settlement date. The question arises is, on which date will you record the shares in your books of accounts? On which date will you record the financial asset in your books of account? Yeah. So on which date to record? That is the question in case of regular way purchase sale, right? So company can follow either of the days. If the company wants to follow traded accounting, it will record the financial asset on the trade date. If the company wants to follow settlement date accounting, it will record the financial asset on the 3rd April. So this can be chosen by the company, but of course whatever you choose, you will have to follow it consistently. Just remember that. Okay, then there was one question number 105, just a fairly simple question, you can just refer it. Okay, so this was regular way purchase sale, not very critical anything about it. Then the next point was impairment of financial asset. In case of financial asset, we have how many methods? ACM, FVT, OCI, R, FVT, OCI, NR, FVTPL, right? In case of impairment, what is the meaning of impairment? Do you remember we also have one index for this, index 36? The index 36 impairment talks about impairment for PPE, investment property, intangibles. This impairment is specifically for financial instruments. Now how to calculate the impairment loss, I will discuss, but before that, do remember whenever impairment loss is there, it will be transferred to profit and loss. That is why the provisions of impairment are only applicable when your financial asset is measured at either ACM or FVT OCI. Why? Because if you are following FVTPL from before only, in that case already each and every gain loss is already transferred to profit and loss. So if your financial asset is at FVTPL, no need to follow the impairment provisions. But if it is at ACM and FVT OCI, you have to follow the impairment provisions. Anyways, then how to compute the impairment loss? So there are 2 methods. One is 12-month ECL, one is lifetime ECL. Which one to follow? If the financial asset is risky, for example, let's say I gave a loan to Ajay, but Ajay is making the repayment on time. So that financial asset for me, that loan given by me to Ajay is less risky for me. I will use 12-month ECL. But for example, let's say I gave a loan to Kishan. Kishan not making the repayment very frequently. He's defaulting on the repayments. Can I say for me that loan given is a riskier financial asset? So I will use lifetime ECL. So basically in 12-month ECL, we calculate the expectation of loss in the next 12 months. In lifetime ECL, we calculate the expectation of loss over the full life of the asset. But this is complicated in real life. But from exam point of view, calculation of impairment loss is fairly simple. Why? Amount of financial asset will be given, probability for loss will be given. Just multiply the amount by probability, you will get the impairment loss amount. As simple as that. Okay. So this was one discussion of impairment loss. There is one more discussion in impairment, that is loss bifurcation in case of financial asset measured at FVT OCI. Let's say for example, you have a financial asset at FVT OCI. What is the meaning of FVT OCI? That means each and every fair value gain loss, if it is unrealized, it will be transferred to OCI. Now let's suppose your carrying amount was 100, fair value was 90. So you will reduce the financial asset by 10 rupees. Now normally this 10 rupees goes in OCI, but some information was given that out of this 10 rupees, the decrease of rupees 3 was because of impairment loss, the remaining 7 because of fair value loss. So whatever is the decrease because of impairment loss, you will transfer to profit and loss, and whatever the decrease is of because of fair value loss, you will transfer to OCI. Do remember that part. Okay, simple. Then we have certain questions on impairment as well. Those are fairly straightforward questions, to be very honest, but still I will just help you go through with the same. One sec. Here it is. Illustration number 50. Let's say, for example, this is a question of impairment. See, what does it have? We have the value of financial asset, we have the probability of default, and also one loss given default is given. Just multiply this 1 million by 0.5% by 25%, you will get the amount of impairment loss. As simple as that. Acha, here also you have been given various financial asset information, how to calculate the impairment loss. Here loss rate was asked. I'll tell you how to calculate the loss rate. Whatever impairment loss is there, it is already given, present value of observed loss. Divide the loss amount by the total carrying amount. Let's say, for example, I did the working in my notebook, in my notes. You can refer this. I will upload this on Telegram. How to do it? I have the loss amount. Okay. And I also have the, let's say, for example, the loss on group X was 600. What was the total carrying amount? 2 lakhs. So how to calculate the loss rate? Loss amount divided by total carrying amount. You will get the loss rate. Loss amount divided by total carrying amount. You will get the loss rate. This is how you calculate. Okay. And there was one question which was of MTP, RTP. That was also very simple question. In that, do you remember I taught you just how to calculate the particular bifurcation of loss? If you have a certain loss, but information is given that some loss is because of impairment, some loss was because of fair value loss, the impairment loss will get transferred to profit and loss, the fair value loss get transferred to OCI. Here it is given. There is a loss, there is a decrease by 50. So this much transferred to impairment loss, this much transferred to fair value loss. Okay. But in this question, there are multiple things as well. I'll discuss everything. First, we purchase the asset. So we record the entry for purchase. See, we recorded the entry for purchase. Then we book the fair value gain loss and impairment loss, everything. Then the carrying amount became 950. In this question, later on, we sold the asset for 950 itself. That means we are selling the asset at carrying amount only. Sale price carrying amount same, no profit loss. But once you sell the asset, because you booked the fair value loss in OCI R means reclassifiable. Whatever loss you booked in OCI, you will have to reclassify to profit and loss because the financial asset is out of your books. So this is the important entry which you will forget. Do remember that part. This was impairment. This was impairment. That part is over. Now the next point is derivatives. What is the meaning of derivatives? Do remember, derivatives we are only discussing in financial instrument from FR point of view. No discussion is done from AFM point of view. Okay, do remember that part. Okay, derivatives means any contract which value depends on an underlying. On initial date there is no or very little investment and the settlement will happen in future. This is a derivative contract, and each and every derivative contract will be measured through FVTPL. Okay, directly focus on the questions here. We have one question that is illustration number 118 of my book as of now. Yeah. Yes. See, it is fairly simple. What to do? Whenever the information for derivative is given, you have to measure the same through FVTPL, right? So for example, let's say we entered into a purchase contract of USD 20,000 at rupees 68 per dollar. Okay. Now, this is our derivative contract. Now the position are given as on first quarter. Settlement will happen after 1 year, huh? But the position is given as on first quarter. We are in a loss of 25,000. So whenever there is a loss, the position is unfavorable for you. So book a derivative financial liability, right? And transfer the loss to profit and loss because we are measuring at FVTPL. On day 1, there will be no entry. On first quarter, we measured the loss. Acha. The position as at 30th June is given 15,000 negative. As at 30th June means does not mean that you have to book another 15,000. Remember I told you this is the as on position. So your loss from 25,000 it has reduced to 15,000. So you will reverse 10,000 ka loss. So reverse it. Okay. Then on the 30th September your position is positive 12,000. Right. So now DFL is over. DFA is there. So whatever DFL is there, reverse it. DFA book it, transfer to profit and loss. Right. And then the ultimate settlement, the ultimate spot rate is 66. Now, whatever is the spot rate, you promised to buy at 68 rupees. You are buying at 68 rupees, but the selling price in the market, but the price in the market is 66. Can I say it is an unfavorable contract for you overall? Why? Because you are going to buy at 68 something which is worth only 66 today. right? So the gross settlement will be done. We will buy at the promised rate. We will sell at the market rate because we are only buying for speculation. So we will have to immediately sell it. Whatever DFA, DFL is there, just reverse it and transfer the difference to profit and loss. Simple. This was the derivative question, which is very fairly simple. Just focus on that. Okay. Then we have one more question, illustration 120. In this, it is exactly same like 118. This question is exactly same like 118, but the only difference is there is a point written of written put option. Now what is the meaning of written put option? So for that you need to know what is call option, what is put option, right? So if I want to discuss about written put option, so put means right to sell. Holder has the right to sell. So writer has the obligation to buy. So when I say written put option, just refer this column. Written put option means writer of the put option. What does writer of the put option has? He has obligation to buy. That means when they say instead of directly purchase, they might write written put option. So this also directly means purchase only, obligation to purchase. If it is a purchase contract, everything else is very much similar to illustration number 118. So focus only on this part in this question. Done. So this was derivative part done and dusted. Now we will move on towards the embedded derivatives. Now what is the meaning of embedded derivatives? Embedded derivatives is a contract where in the host contract, there is also an element of derivatives. Now how will the element of derivatives be involved? Let's say for example, there is an Indian company. We are transacting with US company. My currency is rupees, his currency is dollars. But the transaction is taking place in a third currency, that is yen. Right? So I want to buy guns, but I am making the payment in a third currency. This is known as embedded derivative. When the third currency is involved, we will say that the host contract and the derivative contract are not closely related, and in that case the accounting for host will be done separately and accounting for this derivative part will be done separately. Again I'll repeat, because we are settling in a third currency which is neither my currency neither his currency, right? So there is a derivative portion involved, and whenever you are using a third currency, the host contract is accounted separately, derivative contract is accounted separately. I've made you write this as well. Host contract, derivative contract. First ask yourself whether they are closely related. If the answer is no, when will the answer be no? When third currency is involved. So in that case, do separate accounting of host and derivative. But if the answer is yes, if they were closely related, when will this happen? Let's say for example, you are buying guns, making the payment in dollars. So if you are making the payment either in his currency or in his currency, in that case, we will say the main contract and the payment part is closely related. No need to do separate accounting. Okay. So if they are closely related, no need to do separate accounting. Do remember that part. Done. Then we had some illustration number 100. It is a pretty straightforward question. I'll teach you how to do the accounting. Host contract year is always recorded at the day one's forward rate. Okay. So host contract in illustration number 100 was to buy solar panels. Okay. So you will not record on day one. You will record the solar panel on delivery date, but at what rate? On day one's forward rate. This is the rule. Do remember that. Done. Then treat the derivative part separately. Ideally in this question, there was one Indian company and one Dubai company. Chalo, I'll take you to that question only. One sec. Okay, here it is. Illustration number 100. So there is an Indian company, there is a company of UAE. Currency of Indian is rupees, currency of UAE is dirhams. But settlement is happening in dollars. Third currency involved. So we will say they are not closely related. Do separate accounting. Okay. How to do separate accounting? Buying solar panels, you will record on the delivery day, but at forward rate. Okay. We will record it. Derivative contract. Now you are making the payment in dollars. Just imagine. Do I need to buy dollars or sell dollars? See, because you are buying solar panels, you will have to make the payment in dollars. But you are an Indian company. You don't have dollars. So you'll have to first buy dollars. So a hint is whatever you do in host contract, the same thing you will do in derivative contract. First thing. So buy dollars. Next. Did we fix any rate to buy dollars? The answer is no. If we wanted, we could have hedged our position and fixed a rate on day one. And if we wanted to fix a rate on day one, you could have fixed the buying price of $65. You know that after 6 months, you will need to buy dollars. If you wanted, you could have fixed the buying rate at 65, but you did not. Okay, you did not. Nowhere it is mentioned that we fixed the buying rate. At whenever you want to fix a rate, you will always fix at forward rate, day one's forward rate. So if we wanted to lock the price, buy price, we could have locked at 65, but we did not do it. Now keep on checking the position. Okay. So in the derivative accounting, day one, there will be no entry. What about on the maturity date? On the maturity date, just ask yourself one question. if you wanted to fix a buy price, you could have fixed at 65. Did you fix it? No. Now you have to buy at 66. Profit or loss? Favorable or unfavorable? Of course unfavorable na. You did not fix the buy price 65. Now you have to buy at 66. Unfavorable for you. So derivative financial liability. Okay. So in this question, in the derivative part, there is a loss. Book it. Okay. So here there is some routing done. The host contract, we booked a payable. For the derivative liability also, because we lose, we have to make a payment again. So the derivative financial liability, whatever is there, you book a payable for it. Then both the payables, you will make the payment together. Okay, that's it. This was embedded derivative illustration number 100. We have one more illustration, that is illustration number 119. That also we will discuss. One sec. That is a fairly good question. Please see here. So let's say entity A and entity B enter into a derivative contract. Here we are going to sell equipment. Entity A is an Indian company, B is an Indian company. Both the company's currency is rupees, still transacting in USD. So a third currency is involved, right? Third currency does not mean a third currency. It means that it is neither his currency nor his currency. So a third currency is involved, right? So in this case, we are selling equipment. So host contract and the derivative contract will be done. Because currency is different, they are not closely related. Account for it separately. Okay, so host contract is to sell equipment. When to record it? After 6 months. And at what value to record it? At day one's forward rate. So day one's forward rate is 55. It is given. Day one's forward rate. Okay, so we recorded 55. Okay. Now what about derivative contract? Whatever you do in host, do the same in derivative. If you are selling it in host, you will sell it in derivative market also. But if we want, we know that we are going to receive dollars, we will sell it after 6 months. If we wanted, we could have fixed the sale price at the forward rate, that is 55 itself. Did we fix it? The answer is no. Now check your position. Here on day one, no accounting. Here there is year end also. Information on 31st March is also given. So compare a position 31st March also. How to compare? So if you wanted, you could have fixed the selling price at 55. You did not fix it. Now two rates are given for 31st March. One is 31st March spot rate and one is 3-month forward rate for 31st March. Do remember, you are comparing 55. What is 55? It is the expected rate of 30th June. So compare the forward rate with forward rate only, right? So if this is 30th June's expected rate, compare it with this only, forward rate of 30th June, right? So you will compare 55 with 45. So now imagine, if you wanted to fix the sale price, you could have fixed at 55. You did not fix it. Price went down to 45. Right? Now you will have to sell at 45 because you did not fix the price of 55. Now you will sell at 45. So favorable or unfavorable? Of course unfavorable, because you did not fix at 55. Now you will have to sell at 45. Unfavorable for you. So recorded derivative financial liability. Okay. But this was only checking the position on 31st March. Ultimate date is 30th June. On 30th June, the rate turned out to be 60. Acha, don't say, sir, how are we comparing now forward with spot? Arey Baba, this forward is of 30th June. We can compare 30th June's rate with 30th June spot rate. Na? So now rate turned out to be 60. Now imagine, if you wanted, you could have fixed the selling price at 55. You did not fix it. Now you will sell at 60. You will sell at a higher price. Favorable for you. So reverse whatever DFL was there, book a DFA and transfer to profit and loss. So in net, DFA remains. Transfer the DFA to receivable and record both the receivables. From equipment also you will receive the money, and from derivative also you will receive the money. Done and dusted. There is also one more illustration of my book, illustration 102. You can try that in homework. It is fairly simple. If you are through with 100 number illustration and 119 illustration, this is going to be very simple for you. Just give it a try. Okay. So how to differentiate between a derivative question and an embedded derivative question? This is FR with exclusive. You will not find this anywhere, only in AK sir's notes. Okay. So how to differentiate? How will we come to know that if a question is only of derivatives or it is of embedded derivatives? In derivative, there is no host contract. There is no buying solar panels. There is no selling equipments. There is directly purchase sale of currency. In embedded derivatives, there is host contract and also there is third currency involved. Simple. Okay. Then we will come on towards the next concept, that is hedge accounting. Question number 6 I will revise later on. I will come on towards hedge accounting now. Now what is the meaning of hedge accounting? Hedge simply means to mitigate the risk. When you want to reduce the risk, you will hedge account. In hedge accounting, there are various cases, but from exam point of view, we only have a question on cash flow hedge. So I will discuss only cash flow hedge here. What is the meaning of cash flow hedge? Let's say, for example, I am going to sell my classes to Ashish. He is from Dubai, but he will make the payment after 6 months. That means I am going to receive dirhams that is Dubai's currency after 6 months. Okay, but my issue is I feel that the value of dirhams will depreciate. I feel that the value of dirhams will depreciate. Okay, so now how will I do hedging in this? Whenever you are going to receive money in future, and if you are hedging that future inflow of money, that is known as cash flow hedge. In future, I am going to receive money from Ashish. Okay, but I feel that the currency will depreciate of dirhams. So on day one itself, I will fix the conversion rate. Let's say, for example, on day one, I fixed the rate that after 6 months, when I receive dirhams, I will convert at rupees 5 per dirham. I don't know the conversion rate, just taking a random example. Okay, so I fixed on day one that whenever I receive dirhams after 6 months, I can convert that at rupees 5 per dirhams. I fixed the rate on day one. This is hedging. See, in embedded derivative, we were not fixing the rate, right? In hedging, we fix the cash flow inflow of cash rate, right? So what is the meaning of cash flow hedge? Whenever you hedge your future incoming cash flows, that is known as cash flow hedge. Okay, Acha, how the accounting is done here? Whatever hedging instrument you account, you will account through OCIR. Like in derivatives, we did FVTPL. So whatever gain loss was there, unrealized, we booked in profit and loss. Here, whatever gain loss is there, unrealized, you will book in OCI, R and R. R. Oh yeah. Chalo. So there is only one question on this. Just focus on this question. Question number 14. Let's do it. Come. Here it is. Question number 14. So, acha, don't try to link this with embedded derivatives. Linkage I will do. First, as of now, focus only on hedge accounting. Okay. So here, what was the question is, we were going to sell some inventory of copper. Okay. For USD 100. Delivery is happening after 6 months on 30th September. We decided on 1st April that on 30th September, we will deliver some copper for USD 100. Now, this is my inflow which I will receive on selling. I fixed the rate on day one. I hedged my position at 76 per dollar. Okay. This question is saying we did cash flow hedge accounting. Okay. Now, so we fixed the rate at 76 per USD. That means whatever the rate turns out to be, after 6 months when I receive dollars, I can convert them at rupees 76 per USD. Okay. Now, on 30th September, what is the spot rate? 72. It is given. Spot rate on to be 72. But it doesn't matter to me. I will still convert at rupees 76 only. Okay. Now, further information is given of some prices. First of all, a yield is given of 6%. What to do with this, I will tell you. Don't worry. Then, some rates are also given. On 1st April, future price is given for 30th September. That means 1st April's 6-month forward rate is given 76. Then 30th June's 3-month forward rate is given 74. And 30th September spot rate is given 71. Now the question has one issue, that there are two spot rates, 72 and 71. What to do, sir? So ideally in hedge accounting, bifurcate the full contract into two parts. One is the host contract and one is the hedge contract. For host contract, we will use the spot rate of 72. And for the hedge contract, we will use a spot rate of 71. Ideally, this is a mismatch. In real life, this can happen. There can be two spot rates. But from an exam point of view, this should not be the case because then the answer won't tally. Right? But it is given. So what ICI does is for the host contract, they will use a spot rate of 72. And for the hedge accounting, they will use a spot rate of 71. What am I exactly saying? You will understand once I do the question now. See. In cash flow hedge also, just like embedded derivatives, divide into two parts. One is the host contract, one is the hedge contract. For the host contract, what to do? In host contract, you are selling inventory. So here you will record the host on delivery day, but at what rate? At delivery day spot rate. In embedded, we did something different. That is why I'm saying don't link with embedded derivatives. Here we will record the host contract at delivery day spot rate. But we had two spot rates, sir. So for host contract, use a spot rate of 72. So on day one, no entry. On the delivery day, you will record bank/trade receivables to sale of inventory or revenue, whatever you call it, 7200. Okay, spot rate. Now, what about the hedge instrument? Just remember, whatever you are doing in host, you will also do the same in hedge. So in host, you are selling inventory. In hedge also, you will sell the dollars. Okay, because you are going to receive dollars. Okay. Have we fixed the rate? Yes. We have fixed the rate. Hedging done. That is why it is cash flow hedge. We have fixed the rate at 76. Whenever we receive dollars, we will sell at 76 only. Anyways. Now, hedge accounting, hedge contract accounting. On day one, no entry. Let's check our position on 30th June. Now just see. I have fixed the selling rate at 76. The rate in market is 74. Favorable for me or unfavorable for me? Just imagine. I am going to sell at 76, but others are only going to be able to sell at 74. Can I say favorable for me? So 2 rupees profit. So we will book, just like we booked a derivative financial asset, you can book a derivative financial asset for hedge contract also. Okay, 200, 200. But in this question, yield was given. So whatever gain is happening, this can only be realized on 30th September. That means you are booking the gain 3 months early. So book at present value, right? So we took 6% per annum. So 1.5% per quarter, book at present value, 197. Ideally, we don't use yield in case where the contract life is less than 1 year, but it is given, so we used it. Okay, so we book at present value. Okay, now let's check on 30th September, the ultimate expiry date. One more thing. Because this is hedge accounting, don't transfer to profit and loss, transfer to OCIR, because hedge contracts are accounted using OCIR. Next thing. On 30th September, what happened? We fixed the contract at 76. The rate turned out to be 71. Doesn't matter. We will still sell at 76. So we are going to sell at 76, whereas other participants in the market will only be able to sell at 71. Tell me, favorable for us or unfavorable for us? Still favorable for us, right? So rupees 5 favorable for us because we will sell at 76. Otherwise, the rate in market is only 71. So 500 is the again, but don't book full 500. Out of 500, 197 asset is already booked. So you will only book the incremental gain. That's it. So that means this hedging proved to be successful for you. So receive the excess money from the hedge, and also do one thing when the contract expires, because whatever you booked in OCIR, don't forget to reclassify it to profit and loss at the end. That's it. Clear with this? Yes. Chalo. So this was hedge accounting. Now, one exclusive thing I will teach you. Most of the students will face issue in bifurcation between embedded derivatives and hedge accounting, and how to identify whether question is of hedge or of embedded derivatives. So I have prepared a good summary for you. Again, exclusive from FR with AK. Sir, see, in embedded derivatives, the contract is not hedged, right? And there is a third currency involved, right? That means the currency is neither of the buyer, neither of the seller. A third currency is involved. In hedge accounting, first of all, host is hedged. Second, there is no third currency here. If I am selling to US company, we are dealing in dollars only. Okay, so third currency not there. Either dealing in the currency of buyer or in the seller. So no third currency is there. So bifurcation, you got it. How to identify the question? Okay. Now, accounting can also create confusion because in embedded we are recording at forward rate. In hedge we are recording at a spot rate. So I gave a summary also. In embedded, on day one, for the host contract, you use day one's forward rate. You do the accounting at the end only, but at what rate? At day one's forward rate. For derivative part, just remember in embedded derivatives, we do not hedge our risk. We do not lock the price. Second thing, whatever remeasurement is done, transfer to profit and loss. In hedge accounting, on day one, on delivery date for host contract, we use spot rate. So we will record at delivery days spot rate on the date of delivery. For hedge contract, do remember price is locked. Whatever you remeasure, you will transfer it to OCIR. And on settlement, don't forget to reclassify the balance of OCIR to profit and loss. This is the difference of embedded and cash flow hedge. Do remember, this is not, you will not find this anywhere, but this is only for your use so that you don't get confused by things. Okay. Now the next concept is financial guarantee. Now what is the meaning of financial guarantee? Just see, for example, Ajay went to Dena Bank for taking a loan. Okay. The tenure of loan he asked for 5 years, loan value was 10 CR. Bank charged him 18%. But as soon as Ajay gave my guarantee, so I came in rescue for Ajay. I told the bank that I am giving guarantee for Ajay's loan. So bank was like, oh my God, Aakash Kandoi is giving guarantee. So let's reduce the rate. So bank, instead of charging 18%, now it will charge only 12%. That means because of my guarantee, can I say the rate of interest was reduced for Ajay? So we have to do this accounting of financial guarantee. Now the guarantees accounting will be done in whose book? It will be done in AK's book, the one who is giving the guarantee. And do remember, for AK, it is a liability kind of a thing, because if Ajay does not pay, can I say AK has to pay? So for AK, it is a liability kind of a thing, right? So financial guarantee will be done accounting in the books of AK. How to account for this? On day one, financial guarantee will be booked at fair value. Sir, what is fair value? Because of my guarantee, can I say Ajay was able to save 6% interest? So for 5 years, so take the savings in interest for 5 years and discount the same, book it at present value. For taking at present value, which EIR to use? we have two rates, 18% and 12%. Take the 18% rate, that is rate without guarantee, because that is the rate actually in the market. So bring the present value of benefits, that is present value of interest savings. At 18%, you will get the fair value of financial guarantee. Okay, if there is no relationship between me and Ajay, between the one who is giving the guarantee and the one who is accepting the guarantee, if there is no relationship, you will book the financial guarantee and transfer to profit and loss. Okay, and of course I will not give the guarantee for free. I might charge some commission, so book the commission income as well in my books. Okay, but in above case, let's assume AK was the parent, Ajay was the subsidiary, and parent is giving guarantee on behalf of subsidiary. In that case, on day one, whatever financial guarantee you book, you will not transfer to PNL, you will book it as an investment in subsidiary, because relationship is there. Of course, sir, why it is credited financial guarantee, liability kind of a thing, na, that is why. Also, when there is a relationship involved, commission won't be involved. Okay, so on day one, how to account? If relationship is there, investment to FG, relationship not there, PNL to FG, simple. Okay, then what about subsequent measurement? In case you remember, for financial guarantee, in subsequent measurement, you have to find two amounts. Higher of first amount, amortized amount of financial guarantee, that is just prepare a LAT for financial guarantee, or principal amount into probability of default. Okay, principal amount you will have in the question. This default probability will be given in the question. Use this and find the values. You will get two values, one this and one this. Whichever is higher, we have to keep it at that value. Okay, for this we will discuss in the question also. Just remember, for example, let's say this value turns out to be higher, so my financial guarantee on year end will stay at this value only. Now don't book more guarantee of this value. It means that your guarantee was worth 1.87 CR. Now on year end it should be at 1.61 CR. So from 1.87 you have to come to 1.61. So reduce the guarantee value on year end. Okay, so you will pass an entry financial guarantee to PNL. Sir, always to PNL? The answer is yes. Subsequent measurement difference will always be transferred to PNL, irrespective of any relationship being there or not. To discuss this in more detail, let's do one question now, and that is illustration number 127 of my book. This one. Yes. See. Read very carefully now, because this is the question where you will learn financial guarantee very perfectly. So, son gives guarantee of 10 lakhs for subsidiaries loan. So, parent subsidiary relationship is there. So, we will book the guarantee through investment in subsidiary. Okay. The interest rate without guarantee was 8%, with guarantee was 11%. How do we do it? So, interest without guarantee 1 lakh 10, with guarantee 80. Savings is 30, bring at present value. For bringing at present value, use the discount, use the rate of without guarantee. Okay, we got this. Because relationship is involved, we will book investment in subsidiary to financial guarantee. First point. Now, how to do the year end accounting? Just find two values on year end. One, amortized amount of financial guarantee. How to find it? Prepare a LAT. No? Take opening, take interest, less repayment. What is the repayment? The savings of each year. Less, you will get closing. Acha, do remember this LAT is notional. Huh? Don't think that why are we booking interest, why are we making repayment. In reality, no interest is booked, no repayment is made. This is only notional, just to find the amount. So we got the amount as 51,375. Then second amount we want is principal amount into probability of default. Principal amount is 10 lakhs. Probability of default for first year is 1%. It is given. Right, so we took 1%. We got the amount as 10,000. We will take whichever is higher. Sir, why higher? Conservatism. Liability, the higher, the more conservative it is. So we took whichever is higher, 51,375. Now from 7,311, we want to go up to 51,375. So like a hucha, don't book the full value. From this value, you have to come down to this value. So reduce it. Reduce it by how much? You get 21,936. Similarly, you will do for the second year as well. Okay. This was the case of your financial guarantee. Your financial guarantee is over. Okay, apart from this, there are two questions of my book, that is illustration number 101 of edition 7 I'm talking about, of illustration 101 and illustration number 16. These two questions just refer. These are direct questions, not based on any concept. We discussed them in class, but do refer them. Not earlier I can say, but do refer them at least once. Okay, if you want, I will show you which questions are those. One is, one sec. I will show you which are those questions. One is this one. This one. You will have 3 table kind of a thing. Okay. Just to revise this, in contract number 1, settlement happening on net basis covered under derivatives 109. Under contract number 2, you are buying the oil seeds for your own consumption. So ideally there is a concept of own use exemption. Just remember that part. Whenever you are buying anything for own use, it is not accounted under 109. So it is out of scope. In the third contract, again settlement happens on net. So it will be covered under derivatives 109. Just read it, you will understand everything. Okay. And there is also one question number 16, which you can refer. It is also a good question of MTP, RTP past exam. This is this question. Okay. Just refer it, you will understand. Very easy question. Okay. One more question is left to be revised, which I left in between. That was question number 6. Okay. Let's come and revise that question. It is a very easy, fairly easy question. See what does it say? So we are basically in this question, we are buying 3 financial assets. Okay. One is option which we are buying. One is a debenture which we are buying. One is a shares which we are buying. Okay. We are asked the balance sheet extracts on year end. How to do the accounting? It is very simple. See, first you buy at 10,000. Value on year end is 15,250. It is like a financial asset you are buying. When you are buying an option, it is like a derivative which you are buying. You bought a derivative for how much? For 10,000. The value went on to 15,250. How to do the accounting? See, I will show it to you. Wait. Here it is. See. So you bought at 10,000. You pass the entry. Then on year end, it went to 15,250. So there is an increase by 5250. Book the increase. Now, what will be the impact on financial statements? The option value has become total 15,250. On year end, this much has become. And in profit and loss, book the gain amount. This is the extract. Simple. Acha, for debenture, we bought at 1,50,000. Okay. And EIR and coupon, everything is given. So for financial asset, we follow ACM method. We will prepare the LAT. So book the purchase price, then EIR, then whatever coupon is there, you will repay, you will get the closing. So in balance sheet, the closing value will appear. And in profit and loss, the EIR interest will appear. Okay. Now, the main point was the third part. We purchased the shares. How many shares? We purchased 50,000 shares for 3.5. Right? But the value went on to 3.75. Now the question is, where to book the gain of 0.25? So basically in the last one of the question it is mentioned that we will use FVTPL only when it is unavoidable. In case of equity shares, company have an option to use an irrevocable option to value at FVT OCI NR. Okay, in case you don't remember, go to business model test and CCFC test, you can find it there. So in case of shares, you have an irrevocable option to value the gain loss through FVT OCI NR, right? Irrevocable option. So here we book the purchase first at 3.5. Then whatever is the gain, if you are choosing FVTPL, you will book in PNL. If you are choosing FVT OCI, you will book in OCI. But what is done in this question is they have directly booked the gain in other equity. Why another equity? Don't know. But ideally, either there can be two assumptions. If you are following FVTPL, you should book the gain in PNL. If you are following FVT OCI NR, irrevocable option, you will book the gain in OCI NR. But they are directly book the gain in other equity or equity, whatever is there. So we will, in case you remember what they have done, the same in exam. In case you don't remember, you can follow any of the assumptions. Anyways, so the shares will appear at 1,75,000 plus your gain value, that is 187,500 if I'm not wrong. Also, they did one more mistake. If they are showing in other equity, they should come somewhere in the extract. Na? If you are either following PNL OCI, so it should come either in the profit loss extract. If you are showing it directly in equity or other equity, it should come in equity. They have not shown that 12,500 anywhere. So even I have not taken it, but ideally you can show it. Okay. Anyways, so yeah. Apart from this, I guess everything else is done. So with this, can I say we are through with the complete revision of my favorite, everyone's favorite, financial instruments, right? Just remember one thing. In this revision, I have put in a lot of effort to revise each and every concept along with each and every important question. Even if you are able to tackle this much, it is more than sufficient for you. It is hardly, if you combine both the parts revision, hardly 3 hours approximately. In 3 hours, I have revised full financial instruments along with questions that are also in detail. Do remember, this is easy, worth 20 marks. Don't leave it. Only thing which is required from your side is 2 things. See, while listening to the revision lecture, there might be some concepts which you will recall. Good job. No need to read it again. There might be some concept which even after me revising, you won't recall. That is fine. Just mark that concept. When doing self-study, focus on that particular concept more. This is the first thing. Second thing, when you watch the revision lecture, whatever questions I discussed in this lecture, please do writing practice of those questions. Just referring won't solve the purpose. Do writing practice. That means the concepts which you were able to recall, good job, nothing to be done. The concept which you did not recall, revise it once by self, and then all the important questions write and practice. Remaining questions, if you want, if you have time, you can refer it once. Okay, so I hope this was helpful. I hope this proves to be helpful. Those who are watching it, please do leave a comment. If you have watched till here, do leave a comment. How did you like the session? And I hope you liked it. If you liked it, do hit the like button. Also, if you want the notes, you can find on the Telegram. I will upload the notes on Telegram. You can find it there. Okay, join the Telegram channel. It is going to be very relevant for the important updates. Till then, thank you so much. Also, if you are watching it on YouTube, if you want to buy the full English batch, it is available on bbvirtuals.com. Okay, so if you want to enroll, at least you can enroll. Acha, if you have enrolled or if you have availed the benefit, you can recommend it to your friends in case if you liked it. Only if you liked it, then only recommend it to your friends. Okay, so till then, thank you so much, everyone. Bye bye, everyone. Take care. See you all. Bye bye.